In 1994, famous investor Peter Lynch gave a speech in which he said, "If you spend 14 minutes a year on economics, you've wasted 12 minutes." So, let's cut right to the chase. What does Peter Lynch recommend you do to avoid the heightening threat of stagflation? 1. Understand the threat of stagflation, but don't go overboard. The Federal Reserve generally raises interest rates to combat inflation. This, in turn, affects the prices of capital or even acquiring a mortgage. The cost of borrowing goes up, which means the speed of money flow throughout the economy slows down. And theoretically, this would make stocks less attractive compared to government bonds. Investors are concerned that the gains they have seen in recent years may not continue if interest rates rise. However, famous investor Peter Lynch says that anticipating interest rate increases is fraught with peril. No one has a crystal ball. We simply can't imagine where rates are going, no matter how confident we are. So, while stagflation could see interest rates rise, as they did in the late 1970s, there's no guarantee this will happen. There are only probabilities. Do not go all in with any investment strategy because if you're wrong, you can literally pay for it. 2. Don't try to time the market. Instead, focus on owning good companies and studying their performance over time. Even in periods of stagflation, you should be able to identify companies that will generally perform well. According to Smart Asset, there are several asset classes that serve as safe havens during stagflation, including real estate, value stocks, gold and silver, and commodities. If you're an individual stock picker, you might consider looking at these sectors as part of your portfolio, but with enough diversification to still build wealth if you're wrong. 3. Keep your head and focus on the long term. Stagflation can be one of the scariest market environments. In the late 1970s, there were even lines at the gas station. The government may enact price controls and rationing to keep supply steady for the masses. If this happens, it's almost a worst-case economic scenario. People will be panicking, but not you. If you planned for stagflation, including buying solid assets you believe in, diversifying your bets across different sectors like stocks, bonds, real estate, and commodities, and know what to do in advance, you can avoid irrational decisions and position yourself for the long term when interest rates finally come down again. Interested in learning more about building wealth? Subscribe to Maps to Millions, or if you're feeling generous, simply like this video to share the message.